Hi, Stephen Barrett here. Today I'm going to talk about the difference between income protection and critical illness. A lot of people get the two of them mixed up, thinking they're more or less the same when there's a big difference between the two benefits. So I'm going to get the whiteboard out and I'm going to explain the difference between the two. Okay, the difference now between specified illness and income protection. Specified illness or critical illness is a lump sum payment. So you go to the insurance company and you say, I want 100,000 in cover, or whatever the figure is. They have a list of defined illnesses that apply to their policy. If you get one of them, they will pay out. A little thing in the small print that you should be aware of is if you die from that illness within 14 days of getting it, like if you have a heart attack and you die from it, or you die 2 days later from it, they will not pay out. You have to survive the illness for 14 days. Also, obviously, it's critical illness plan. It's not a death plan, so if you get knocked down by a car and get killed, it does not pay out. So what I do for my clients is I always attach an element of life cover onto the plan. It costs €1 or €2 extra. In some cases, it's actually cheaper. And that means if you do get a heart attack and die from it, the life cover plan will pay out for you. It's not that cheap. So what I usually do for clients is we attach it to debt. So if you've mortgage repayments, what we do is we calculate how much your mortgage repayments are for the next 4 or 5 years, and we insure that amount. So if you do get a serious illness, you know that the plan will pay out your mortgage repayments for the next 4 or 5 years, and you don't have to worry about paying that bill. Income protection then. Income protection is a replacement of your salary. So say you are on 60,000 income. The maximum you can take out in cover is 75%. Okay? Which is 45,000. Now, if you get any other benefits, that is deducted from that 45,000. So if you are an employee, you are entitled to a state disability of €9,776, which means you can insure yourself with the insurance company for 35,224. If you're self-employed, you're not entitled to any sickness benefit at all. So under both circumstances, the total payout is 45,000. The self-employed person gets it from the insurance company. The employee gets it from a combination of the insurance company and the state. Now, the plan is paid out. It starts paying out after what's called a deferred period. How long do I have to be sick before the plan starts? Usually it's after 13 weeks, but you can have it starting as soon as 4 weeks. Or in some circumstances it starts after a year. That's typically in situations where an employer has stated in the employee's contract that they'll pay full salary for a year before stopping any salary benefits. Now, the plan will pay out until you return to work or you reach retirement age. You can choose the retirement age 60, 65. 65 is the latest you can have. So let's say you have a worst case scenario of someone, a 35-year-old on 60,000 has a very bad accident and cannot work again. They will be paid 45,000 a year until they return to work. For 30 years, these plans are index linked. So the plan will increase by 3% every year. The total payout over 30 years is 2,140,000 £893,000 or £93. So you can see the total payout is huge if it happens. So insurers tend to, because the risk is so much higher, they tend to charge more for it. Now you do get tax relief on the premiums, so that does reduce the cost. But as with most things, if you get tax relief on the way in, then you get taxed on the way out. So any benefit that you have, that you receive, is taxed under the PAYE system. Okay, I hope that explained the difference between the two different plans. If you have any questions, you can give me a call on 01485 3305 or drop me an email at stephen@bluewaterfp.ie. Look forward to talking to you again soon. Bye.